Today's presentation, I'm going to be talking about an hour on how to buy a remote rental property. This is not going to be giving you guys any legal or any kind of personal or financial advice here, just a bunch of ideas. So if you guys don't know who I am, my name is Lane Kawoka. I am the creator of SimplePassiveCashflow.com, a podcast that I started in 2016. My professional resume is a bunch of engineering degrees that I don't use today. In 2019, I finally quit my job, and I am a full-time professional investor these days. I grew up in Hawaii, moved to Seattle in 2003 to go to the University of Washington to get that engineering job that only got me into the workforce for about a decade. But more importantly, in 2009, I began investing in an A-class rental that was $350,000 and rented for $2,200 a month. You could call me an accidental landlord. The mortgage, the PITI was $1,600. So for a young, early 20-year-old kid, that was $600 a month of beer money. I didn't know anything about repairs, expenses, or how you had to save some of that money. All I thought that $600 was a lot of easy money, and at that point, a few years into my career that I didn't like, I realized that that was my ticket out of the rat race. So in 2012, 2012, I bought another property in Seattle, a duplex, this time a little less of an A-class rental. But in that time, the market around Seattle and much around the country too started to pick up. And I realized that nobody really invests in primary markets for a cash flow. A lot of unsophisticated money will invest in primary markets like Seattle, California, for appreciation. But smart investors who are looking to preserve their capital are looking for investments that hold on or are able to balance out the income and expenses. So I went out of state, started my building an 11 single-family home portfolio in Atlanta, Birmingham, Indianapolis, and Newcastle, Pennsylvania. Did a little international farmland investing in that meantime in Panama, and the big thing is I started investing a lot of money in my education, getting mentors, and joining higher level mastermind groups. Those are my first few properties in Seattle that I purchased. So you guys are familiar with the area. And of course, moving far, far away, a lot of those properties in Birmingham, Atlanta, Indianapolis, I did not actually even visit. A few of them I haven't even never seen. I've bought and sold them. But you can do it all with the internet. And today I'm going to kind of show you some tricks and tips to do that. After 2017-18, I moved back to Hawaii, continued investing more money into my education and traveling around and meeting more astute investors. And I started to create this investment club called the Huido Pipeline Club. So far, we've acquired over $250 million in real estate. And I've raised over $15 million within the group over the last couple of years, 2-3 years. Today, I currently control 2,600 units. That's 15 apartment buildings, 2 manufactured home developments, and those are some of the cities below that I am in. I had 11 single-family homes in 2017. In 2018, I sold 7 of them, and I have about 4 of them left. 2 of them are vacant, being ready to sell at the moment. So I'm slowly getting rid of my single-family homes. So I've kind of gone full circle. But in the meantime, I still help out a lot of investors in my mastermind group, my group coaching group. So I'm very plugged into the market, and I was able to kind of vicariously fine-tune my skills with this out-of-state remote investing with, by helping out my investors. So if you guys haven't heard my podcast, SimplePassiveCashflow.com, a lot of the first 20 podcasts are all about single-family home investing, how to buy a turnkey rental, or how to vet operators and property managers. We'll talk a little bit about those concepts today, but if you guys want the full education, It's free 99 on iTunes, Google Play. Again, just type in simple passive cash flow, it'll pop right up. If you guys want a free copy of my ebook, One Thing That Changed Everything, text ebook to 587-317-6099. The first question, I think, I usually start with this question because it's sort of a living belief. People think they don't have money to do this. What is the average down payment? Question is here wrong, but the down payment to purchase one of these rental properties, a lot of times these properties are $100,000. I'm looking to buy a property that will rent for at least $900. And for that, you're looking at about $100,000 purchase price, but you're putting down the 20% conventional down payment. So you're looking at anywhere from $20,000 to $25,000, a little extra for some cash reserves. So you can start doing this with as little as $20,000 to $25,000. I know there's a lot of other strategies out there that you guys see: no money down, lease options, a lot of very complicated stuff in my opinion. The reason I created Simple Passive Cash Flow is that this website, all this content is made for more passive investors. Fortunately or unfortunately, you need to have a little money to invest. If not, you've got a money problem. And there's a lot of ways you can make money. You can sell drugs. You can do all kinds of crazy things. Some of those I don't condone, but however you do it, and you can even work at a full-time day job to do it. You need money. Like I said, $25,000 to pick up one of these properties. Like I said, the active investing is wholesaling, all these, things I think you see on HGTV. In my opinion, these things are not investing. It's more of a business. Where passive investing, there's a few items in there that we like to do, like rentals. Private money investing, I don't like that at all. You're more of a debt investor. There is no equity, which is the upside in case the deal goes extra well. And you don't get any of the tax benefits associated. Different reasons why you would do one or the other, but essentially is if you don't have very much time, you got some money, and you're able to keep your documents organized, passive investing is the better way to go. If I think of active investing as ways to generate capital, to get money, to get that $25,000 to purchase more investment properties on the passive side. A lot of you guys who are listening are high-paid professionals. You guys can do this at your day job. Might have to just pick up an extra shift, or a few of you guys are doing your own startups or your own self-business folks, and that's the way you guys generate your capital. If you guys want to take a little screenshot of this page, feel free to. But here are all the ways you can invest as a passive investor. What they are, the pros and cons. In my opinion, different ways to invest come in different progression. And when I talk about progression, it's experience and where you are in terms of net worth. Basically, how much money you got really determines where you go with it. So here are some of the questions that people will ask, and I'll kind of flash them up on the screen. A lot of these are pretty good questions, and the questions I hear from first timers. And if you guys have other questions, again, feel free to type them into the question and answer box on the bottom of the screen. Question here: what do you ask a potential renter? Can you ask for all this stuff? Can you share a sample rental agreement? Now, I put this in here sort of as a trick question because I don't know, to be honest. I know 1/3 of the the rent is what their salary or your monthly income is. But other than that, I stay out of this. Remember, I'm a passive investor. I'm not a landlord. These questions are for my property management. And part of the reason I do this is also for liability reasons. If there's any kind of discrimination, or we don't allow dogs, and now they say that their dog is a service animal. I see those questions posted on all these forums all the time. And I'm like, well, what a waste of time. Just let your property manager do it. I mean, that's what I'm all about. My highest and best use up to six 6 months ago was at my day job. It wasn't screwing around with all these little things. I mean, this is what these people that you pay, 50 grand or 100 grand, or they make 50 grand or 100 grand in their jobs, they do for you, and you pay them 8 to 10% of the income. It's a business. So some of you guys are typing some things into the chat box. Make sure you guys check them into the Q&A box. I'm not going to be checking the chat box here. So if you guys want to retype it in there, please do so. So what it comes down to as a passive investor, you need to always be thinking about, time, money, knowledge. Where do you fall in these resources? If you don't have too much time, but you got some money, well, you can buy a passive investment such as a rental property or go into a syndication. I would say syndication, you probably need a stronger network of people. The first concept I wanted to kind of talk about with folks is the rent to value ratio is kind of the starter. Um, there's a lot of math in real estate. Luckily, it's not too complicated, but here's the first of it. So to get the rent to value ratio, take the monthly rent divided by the purchase price, and that's your RV ratio. For example, $100,000 home that rents for 100 grand, that gives you that 1,000 divided by 100,000. That's a rent to value of 1%. Now, why is that 1% value so important? Well, after you are able to analyze these properties and see how they perform, you start to realize this 1% is the quick and dirty way to see if you can cash flow after paying expenses, um, for the most part. If you guys want to read up more on this and see more examples, go to simplepassivecashflow.com/RV. A lot of people that live in primary markets, like Hawaii, you have almost $1 million house that rents for $3,000 a month. That's 0.33%. In Seattle, that first property I bought back in 2010, $350,000 that rents for 2,200. That equals a 0.63. Obviously, today that property is almost 2 times as much, so that RV ratio has dropped. This is probably one of the most critical things to understand when you are a cash flow investor. And I think a lot of you guys who are possibly going straight into syndication just don't get. It's simple though. I mean, here it is. Just sort of think about it, embody it, and when you're kind of looking at large apartment deals like 100 unit, break it down to each per unit basis. So here are some markets that I do not suggest investing as a cash flow investor, and we categorize them and we call them primary, secondary, and tertiary markets. So primary markets, all the cool places to live, like Hawaii, Los Angeles, San Francisco. Great appreciation, but me personally, I'm not really looking for appreciation. I want cash flow today so I can quit my day job, and I want capital preservation because I don't know when the next recession will hit. Personally, I'm pretty bullish on the current economy right now. I think we're going to keep going, especially if the China trade deal gets done, but I don't know, right? Um, so I invest in secondary and tertiary markets, and there are some good examples of what those are. You can sort of go by population size on these a little bit, but I mean, there's no hard and fast rule on these primary, secondary, and tertiary markets. Some other places that are sort of outliers are like Tacoma, Washington. You would think it's not Seattle, but because it's so much in proximity to Seattle, it's essentially a poor man's primary market. Kapolei, Hawaii, which is probably about 10, 20 miles away from downtown Honolulu, is a primary market. I mean, even though it's in the less desirable side of the island, it's still in close proximity. Austin, Texas is sort of in like, the nice place, nice cost of living area in Texas. However, Austin is sort of the oasis in the desert there with such a high population of high tech jobs there. It's very much an outlier. Las Vegas and Phoenix, I think we'll talk about those a little bit later, but they on the surface are secondary markets, but they have so much. There's so much in proximity to California that a lot of Californians will go there and start to invest just out of the pure convenience. Or they've been to Vegas, right? They've gone through that airport and they know it exists, and therefore, hey, we can't afford stuff in LA. Let's buy something in Vegas. So there's a lot of dumb money there, and I would say stay out of those. We talked about the 1% uh, rule there. I'll talk about the 50% rule here in a bit, but if you guys want to download the simple analyzer and go down line by line, I know a lot of you guys are engineers, so you guys will love this stuff. It'll show you some rules of thumbs that I use to estimate each expense line item from property management, vacancy, capital expenditures. So you guys will really like that. And here it is cut and paste onto the screen what some of those components are. And you just start to do this a bunch of times, and you're like, oh crap, Lane was right. Like that 1% is what you really need. Going back to my Seattle property, it looked like I was cash flowing $600, but in actuality, like, I was paying a property manager too in there that was 10% of the income, and then things broke, right? Even if it was a new property, things broke. And what I didn't see and why it ultimately sold is because I knew there were big CapEx issues going to be happening, like it would have to tear a roof or fix the washing machine, or fix some kind of larger issue that would come down the road. So I wanted out before that happened. So one big rule we use a lot in real estate investing is the 50% rule for expenses. So what this says is you take the monthly rents and you divide it by half, and that's what you should be able to expect to walk away after you pay for all your expenses, which are, again, property management, maintenance, repairs, vacancy too. So you can also do this on your larger buildings, right? Like I said, apartment buildings are just, how many units, and break it down into the one. So figure out what it is per cost basis on each unit and apply this 50% rule for expenses. Apartments are nice because at some point you start to hit a good amount of scale, and you're able to, your expenses sort of go down. So one rule of thumb I like to use for large apartments, which maybe probably not really applicable to today's talk on rental properties, but I like to use like $4,000 per unit, which is very low for houses. Because remember, apartments, if you think about it, it's only the box inside, whereas a house, you've got all this external stuff, a yard, a roof, all these other issues that could happen. A lot more surface area for screw ups. Here's how the 50% rule works from a high level. You take the 100, if your monthly rent is $1,000, you got to pay your property manager $100, and $100 bills go out to repairs, vacancy, and also large replacements. I know that only adds up to $400, but trust me, there's always someone who takes that extra $100 after that. Going back to what markets to invest in, here's a little diagram of some international gateway markets that I would personally stay away from. A lot of international, I think United States is pretty much it's an outlier in the world. I mean, I think America is pretty much the only place where you have rent to value ratio of 1% or higher. Many parts of Asia, many parts of Europe, it's like 0.5%, if that, or much less. Many places actually, another reason why United States is a great place for investing is our great lending. Had a podcast with Richard Duncan, and very interesting guy to follow. And you guys should Google him, but he's got this theory on debt is the thing that kind of propels the economy forward, and he doesn't believe in the 8 to 12 year market cycles at all. I mean, it's all based on debt, and in theory go on forever as long as it's no big hiccup. Here are some markets. Here, so basically, this one is showing you the green ones are some markets that with diverse economies. The red ones are not diverse economies. So this is just one thing to look at when you're picking a market to invest in. You want to pick a market where you've got a diverse amount of employers in the area. In this one, Atlanta, Georgia is lit up red, which I totally disagree. So always, you never these type of graphs and pictures, you can find them all over the place. They're just, if anything, entertainment value, if anything. And if you guys subscribe to my email newsletter on Simple Passive Cash Flow, and then you put in an email there, I usually try and share this a lot. Or if you guys join the Facebook group, I usually will kind of, as I run across this stuff, I'll cut and paste it into there so you guys can be fed the newest stuff. Another reason why I don't like to invest in primary markets is that they're called cyclical markets because the price goes up, then it goes way down. Um, and this kind of makes me very frustrated because I talk to very unsophisticated investors and they're like, well, my California house went from 450 to $1 million. I'm a genius. Well, you're lucky because you just happen to invest in a decade in a bull market. And me personally, I'm fortunate to be this way too, but I sold my 2 Seattle properties to translate it into more cash flow. Maybe I did a little bit earlier, but um, you know, personally, I'm more about the long run and capital preservation than to lose it. And you see California lost 42% from the peak to trough. And again, like there's that Nevada market, the Las Vegas market, -60, and especially Florida. I was talking earlier today about how Hawaii condos, people are going to put down a lot of money before they're even built, and that's very indicative of what was happening in 2007 in Florida. People, they were buying properties with, just getting the contract, and when the property was being built, they would flip the contract and make a lot of money. I mean, that's just a sign that easy come, easy go, things go up, they're going to come crashing down. So one of the big indicators that I look at when I'm going to invest is where is the population going to go. It's no secret that a lot of the population is moving to the southern states. If you draw a big happy face on America, that's pretty much where they are going. So part of this, maybe people want warmer weather, or maybe it's immigration. I don't know what it is. I don't care. But that's why I invest in places like Oklahoma City, Texas, El Paso, Louisiana, Mississippi, Alabama, Georgia. So I see your guys' couple of questions there. I'll get to them probably a little bit later in the presentation. I'm not ignoring it. I see it. I apologize for that. Another report that I personally look at is this Van Line report. Van Line report is a report done by when a white collar worker is going to get moved by their company, the company will get a van line to move them. So this is sort of showing the richer people, basically, the working professionals, where they're moving. And as you can see, they're sort of kind of just moving along different trends here. A lot of those northern states are kind of an outgrowth, and you can kind of pick this up every year by year. It's something interesting. But what I really look at more is the U-Haul report, which is the blue collar workers or the other cheapos. Pretty much the majority of America probably use U-Hauls as opposed to getting the company to move you on their dime. So, here are some of the bigger states. This information is a little old, but you get the gist, right? You see where they're going. They're moving from California, getting the heck out of there because they're tired of their state going broke, and they're going to the southern states. I put this slide in here because I wanted to touch upon some of these concepts. Geez, did I spell that wrong, or is it getting later in the day? But international money, I mentioned, I talked about that, staying away from international money because a lot of money from China are just wanting to purchase properties in places like Seattle or Los Angeles or San Francisco cash. It's crazy, but to them it's not. I mean, they might make 1 or 2%, but that is it's great for them. Great what than what they're used to. A lot, there's some European countries and Asian countries that are sort of getting into negative interest rates. So for them, that's a good deal. Um, I'm just gonna stay away as far away from them as possible because they're gonna push things up. And that brings into the point number two is unsophisticated money, which is international money too. But these are, the people that are going to Phoenix, Vegas, investing in California out of just pure convenience, or they don't want to get out of their comfort zone. I want to stay away from them. A lot of people in primary markets, what they're starting to do is do short-term rentals. And that's why you're seeing a lot of people get into this stuff. And that's why personally I want to get out, because you're in the amateur hour and no one's going to win in that situation. That's why I like to use Airbnbs whenever I travel, because it's such a good deal, because everybody wants, there's a low barrier to entry for people getting into that stuff. College towns, I don't like them. I think there's going to be a big bubble in colleges, but that's me getting a little political. Um, I just see it as sort of an external stimulus where the price of college is going up and up and up because people can pretty much get an unlimited amount of student loans, which is a sad thing. But as an investor, you see these big trends happening, and me personally, I just don't want to invest in that. Again, it's near primary markets typically, and for some strange reason, whenever any adult gets some money and wants to be a landlord, what do? Well, they go look at where they were a renter first, which is typically in their college town. I want to be far away from that kind of person as possible. Number four, military towns. Now, you love the military, but you never know when like the federal government is just gonna turn and go in a different direction. I don't know too much about military stuff, but my viewpoint is it's an external stimulus, and I don't really want to invest alongside of that. Um, Number five here, you need to be cognizant of red and blue states, not to be political or anything here, but the red states typically favor landlords. Blue states are very hard for landlords. Like, I mean, California, I think you need like 9 months to evict a tenant. So you can imagine if there's any kind of economic turmoil and people start losing their jobs, well, you as the landlord are going to have, or even as the investor managing the property manager, your hands are tied because now you have to have 9 months in California to flush out a tenant. Whereas, my properties in Georgia, you can just evict them, right? I mean, it's my place. You guys don't pay, you can't stay. Of course, then they screw up your property, but that's another story. You guys can look at that YouTube video that I have on my YouTube channel of that disaster. Point number six here, and this is what I personally invest in, not saying that it's the best, but it's just my philosophy. I go after blue collar workforce housing. This is in terms of the bell curve of the population in America, this is where most Americans are. So I'm gonna answer one of these questions here from the Q&A box. Question was, do you think about investing in a duplex or possible turnkey duplex versus single family homes? So here's my answer to this. Make no mistake, duplexes, triplexes, or quads will have better cash flow. I mean, your rent to value ratios will be stronger. Two things to be cognizant about is the quality of your tenant will likely drop because the individual rents of those units will be less. One rule I have that I tell all my mastermind group is stay away from rents that are under 900. It's very tempting, and the rent to value ratios might look amazing, But as you go to that lower end tenant, under 700, under $800 a month rent, it starts to get very hairy, and then your whole dream of a passive portfolio goes away. I just think it's a little bit more risky, but it could be more lucrative. The reason why I tell most of them why I sort of preach just sticking with the single family homes is because most of the simple passive cash flow people I'm talking to are high paid professionals. These people make over 100 grand a year. They're not broke, and they will likely graduate towards private placements and syndications in very near future. I would say maybe a couple years or a few years or 5 years. And in that case, you need to start to be thinking about the exit strategy a lot quicker. It is a lot harder to sell a duplex, triplex, or quad in a market. And because I've tried to do it in Seattle, it takes forever because you're trying to sell it to another cheapskate investor. I'd much rather sell to a single family home retail buyer who's emotional and falls in love with the property for some strange reason, and they're willing to overpay. And that is, you don't try not to count on that, but that nice little bump is not going to really happen with a duplex, triplex, or quad, an investment grade property. It's going to happen with a single family home rental. But that aside, a single family home will typically sell much faster than a investment grade property. So again, for people with good salaries who are going to step up to private placements and syndications when their net worth gets to be above $500,000 or $1 million above, you're going to want to unload these properties. And that's what I'm doing. I've got 4 more of these left. You guys want to buy them? Hit me up. Let me know. They're renting for like $900 to $1,000. You guys can pay 1% rent to value ratio, which is like $90,000 to $100,000. Great properties, but I'm looking to take the next step and make my life simpler. But I still think if your net worth is under a quarter, especially under $250,000 to $500,000, you really should start to think about single family homes. Now, for people who are lower on the spectrum of net worth and don't make too much money, like if you're just making 50 grand, you're able to only save maybe $55,000. Yeah, maybe you should get a duplex or a triplex and bump up your cash flow in the meantime to save more money to buy more investments. But you're probably looking at 10 years of grinding through this before you even start thinking about going into private placements and syndication as your net worth grows. So yeah, let me know if that kind of answers that question, kind of a long-winded question. So someone is asking about multifamily. We're not talking about multifamily today, guys. This is the single family home show. So part of single family homes is, get back to the slides here, property classes A, B, and C, and D class. You can talk about them in terms of just the building itself, and you can talk about in terms of neighborhood. But in this case, we'll just sort of mash them together. So A class are typically your luxury properties, the nicer places to live, where the yuppies live. B class is a little bit of a mix. C class is mostly blue collar, Section 8, and D and F class are pretty much known as war zone properties. You can also break it down by the asset class, like I said. So the class A are the built after, they're the new builds built after 2010, say. Class B are maybe 10, 20 years old. Class C is 20 to 30 years old. Class D is like really old properties. So someone asked earlier, like, well, why don't you hold on to these properties longer? Well, as you can see, your property is sort of just always sliding on this spectrum. It's always getting to be an older property. When we do multifamily, what we do is we typically pick up a class B minus or a C property, inject some capital into it, maybe a few thousand to $6,000 of rehab into it, temporarily get it back up to a B, but it's still on that slippery slope backwards. Um, the building just getting older and older, and that big CapEx wave is going to hit you. And that's why a lot of times our holds are only 5 years long. So, when you're picking up single family homes, you're typically looking for something that's a B minus C plus. Like I said, just like how we're doing with the multifamilies. And if you're looking to do value add, you can possibly bump it up to a B class. But most single family homes, I advocate for a newer investor. You should start to, just go turnkey. Very little rehab up front, and that way you don't have to worry about any out-of-pocket costs later on. And those out-of-pocket costs are what hit you in terms of return on equity. Because if you make all the repairs in the front end or buy a turnkey, you can finance that into the loan. Like we said, the other way of designating classes is by location. So you usually try and look for a B or A class location because you really can't do anything about that. And here's a little chart from Millionaire Real Estate Investor by Gary Keller. Great. If you guys want to take a screenshot of that, go ahead. But it's great to kind of, if you're into graphs, this is great, and it teaches a lot. It basically tells you that there's a little sweet spot between the B and the C class in terms of headaches and how much money and cash flow you're making. One thing I want to say was, what does this mean? There's no hard and fast rule on what is A, B, and C location. But I would say A class is, this is your cool places to live. This is where, you can go jogging at night. Me personally, I would be fine walking around during the daytime at a class B location, maybe even taking a quick jog. But I definitely wouldn't want to be running around on a class C location. Not to be sexist or anything like that, but if you see, younger women running around taking evening strolls at night, it's an A-class location. They're likely only to go out in the B-class locations in the daytime. You're not going to see them in the C-class locations, even in the daytime. Me personally, when I go check out a C-class property, I stay pretty close to my car. And I don't even invest in Class D enough. I'm sure you can make a lot of money doing that, but I just don't want to do that. So that's just, a lot of this stuff is intuitive after a while. And that's why I have, people come out to me, visit properties with me. We're going to have an investor tour from July 21st to 24th. So I can really show you guys what an A class, B class, C location is and what a B building is and what a C building is, and that way it'll be very simple. You'll be like, all right, 5 minutes walking around, I got it. Let's just go eat some Chick-fil-A because we don't have that at home. So here are how some of the buildings and apartments are on the spectrum of class A to C. Again, most of the population, and this is not scientific, but most people live in lower class housing. This is just the bell curve of America. The baby boomers predominantly live here. The Gen X's live here. The Gen Ys live here. And as the younger guys, they don't have much money, right? So they're living in the worst areas, but they're slowly going to move up. So what happens in a recession or any kind of economic slowdown? Well, the theory is that the bell curve will slide backwards. So what that means is the A's will move to the B's will move to the C's will move to the D's. And the millennials will move back up home with mom and dad. That's a joke, but that's essentially what's happening here. And that's why it's nice to invest in class B and C and stay in the middle so that as the economy takes a tumble, the A's can come back and backfill your tenants who may lose their jobs and have to move out. I mean, it's no mistake that there are market cycles, even though Richard Duncan kind of talked me out of it a little bit. there are recoveries, expansions, hyper supply, and recessions. Today, as of July 2019, it is the longest expansion period ever. Ever. We have the lowest amount of unemployment right now, something I kind of look at, and the 10-year treasury, and this is a 10 and 2-year. This is the inversion that's supposed to predict the end is near. But it's all charts and graphs, right? You never know when the end is really going to come. And I think what I see most investors who are under $500,000 net worth is they just get freaked out of this stuff and they use it as an excuse not to do anything. In my opinion, as long as you're investing for cash flow and the prices of your properties go down and you still cash flow, I think you're fine. I think that's the name of the game if you're under $500,000 to $1 million net worth, is just to keep investing, but just underwrite the deal so that you're fine in case of a recession. If not, you can just be like everybody else investing in the stock market and working for 30 to 40 years. The big takeaways here is don't lose money. Cash flow is like king. Secondary and tertiary markets with robust economies and class B and C locations are sort of the king to hedge yourself so that the A-class people move back to your properties as they kind of fall down and on their face and lose their jobs or have to take less paying jobs. So one question that comes up a lot is, how do you find good cash flowing properties out there on the mainland without knowing the neighborhood? This is kind of coming from a Hawaii person here who a lot of times, people don't travel to the Midwest. I mean, I was in Dothan, Alabama, first time I've been there a few weeks ago. But it's rare that people even make it out to somewhere like Birmingham or even Atlanta, I mean, if you go to the airport, it doesn't count. You got to go drive around the outer ring of the highway loop and see some of these B and C class locations. Going to see the Coca-Cola Museum doesn't count. So I'm very bummed that the Lakers didn't get Kawhi Leonard or some other big three guy, because then I would have changed this. But here's your team when you're trying to do this remotely. It's a 3-man team of a property manager, which is PM, which is the late Dwayne Wade there, and LeBron James is the inspector. He is another important person. And the third guy is the broker. And for those of you guys who used to watch the NBA about 10 years ago, Chris Bosh really didn't do too much. And it's kind of the case here in this example. Really, the property manager and the inspector are really your two biggest components of your big three. You get those guys on board, the broker is just sort of an add-on. A lot of you guys know what I feel about brokers most times, whether they're a lending broker or they're a buying agent broker or even a life insurance broker. I mean, they get compensated when you buy and off commissions. So they're not always aligned with what you're trying to do here. I mean, when you find one that is actually an investor and actually knows what they're doing and knows the area, then that's gold. But whether Chris Bosh goes for 9 points and 7 rebounds or goes off for 30 points, it really doesn't matter, right? As long as Dwayne Wade and LeBron get theirs. So that's the analogy there. Sorry if you're not a basketball fan, but the takeaway is the property manager is your first person that you need to get on board on your team, because this is your person who is going to, you're going to send them, hey, I'm going to pick up this property at 123 Main Street. Can you give me a second opinion on these rents? This is what I think they are. And then the inspector is going to go in there and make sure you're not buying a lemon. If you guys got any questions on this, again, type it into the question and answers. And I'm kind of heading up to the end of this, I think, soon. Question, who will be managing the property if it's out there in the mainland? A property manager, like we said. So here is the segment where I kind of go into this article that I wrote. You guys can access this on, actually, I don't know what the URL is, but if you go to Simple Passive Cash Flow and you type in property management, I'm sure this article will come up But here are some of the questions that you should ask. So number one, that question, which you're just trying to find that they've been in business for a while and they're just not complete newbies. Number two, that one's not too important, but a lot of these questions, you don't want to be a robot when you're asking these questions. I wouldn't suggest asking all 25 of these questions, maybe about the best dozen you can, but use them as a starting point just to create a conversation and understand, get to know them as a person, because at the end of the day, it's people you're working at. Good property managers, they don't want to work with a machine who's going to go through all these questions and spend an hour with them. Any good property manager, any good business person, is trying to fire their worst customers. Like number three, that's a good example of sort of a stump the chump question. Maybe you don't want to ask that. Number four, how many units are you managing? I would say, you want them to have a good volume, maybe about 100 properties at least. Anything more than couple thousand is getting to be on the larger side. So it's good and bad if they're big or small. Big, they've got a little more systems. They're probably going to be a little more costly because they have more overhead. Smaller companies, they likely will be a little cheaper, but I think that's where you have most times where the biggest fears, like these property managers will like embed your money and like run off with it. Of course, very, very small chance of happening, but they typically happen with these smaller companies. Number five, how many property managers? And so this is kind of going to how many staff, how big they are as a company. I personally like to work with smaller property managers just because I work with the same individual and they know all aspects of the properties, as opposed to like you call them up, you talk to the nice person who answers the phone, but they don't know jack what's happening out in the field. I've worked with those type of people. I just don't like that. Number six is just sort of a random question. Number seven, this might be a stump the chump question too. How many vacancies do you have right now? I don't know. If it was me, I'd be honest. Like, dude, I don't know. I can find that out for you, but what is it? What's it to you? I mean, maybe 8 is probably a better question. Average time to fill a vacancy. Part of it is you just want them to answer it honestly and just see how they answer the question. If they're like, we fill it in the next 2 days, it's like, really? Do you guys really do that? Or, I mean, you want them to sort of give you an honest answer and just educate you too, because maybe they're like, hey, look, we'll be honest, man. Like, sometimes it's a week, sometimes it's 3 weeks. It really depends on the market, and that's a good example of a good answer. You can ask them to see their sample leases. What is your late rent policy, or what is their procedures? First, because you're checking if there even procedures. What are their protocols? Are you guys going to be splitting the late fees? A lot of times what I like to do is like split the late fees 50-50 with them, because normally late fees and that's another revenue source with them. So I'm like, well, I mean, I get it's kind of a pain to run after these people for late rent checks, but that's your guys' job. But at least if they're going to be late, I want to make a little revenue out of that too. So that's why I do it like that. When do they perform property inspections and how often? Some larger companies will actually charge you to do this every quarter on top of all of the fees that they charge you. What percent of tenants do you evict? They may not have that data off the top of their head, but they should be able to quantify you in like a nice paragraph, I think, based on their experience, because they're in the game. They see this every day. They should. Drives me crazy. Some people they don't know like basic stuff on their job, and it's like, dude, this is your job. You should know this. Like, I know you don't know it exactly, but you should give me a range. You can ask them what is the procedures if there's ever evictions, and are you guys paying for it, or how much is it? Good things to ask so that you know personally down the road should this ever happen or when it does. What are their management fees? Typically, it's 8 to 10% of the monthly rents of the income, and there's always a lease up fee too to be. So you should also ask that, which kind of falls into the other fees. Um, I think the number 10 is probably the most important one. If you can get any references to be able to talk, again, they're not going to give any references that don't like them, right? So that might also be a dumb question too. But the dummy warming here on the right side, and I'll say this again, don't be a jerk when asking these questions. Let it be a conversation instead of a stump the chump game. You need a good property manager more than they need you, especially if you're a whiny or whiny owner. Some tips to be a better investor and managing the manager is being that squeaky wheel. You don't want to be a pain in the butt, but you also want to keep them accountable. Don't go too far and don't become that guy that they're all like, oh no, Barry's calling us again. That guy's such a pain in the butt. Let's just not help him at all so he leaves us and fires us so we can be done with him. And if somebody's doing a good job for you, give them referrals to, of your friends to work with them. That's the best way that you can add value to them. And I'm all about adding value first. Too many people in this world are in it for themselves. And, by helping them, you can increase their business to help them scale and be more profitable. And it's just the right thing to do. Here's an example of I think there was something that I don't know what my property manager was doing, but I needed to keep them accountable. So I, I'll send them this. Hey, just following up on this. On this day, you said this. What's going on? Same thing here. I use this application called followupthen.com. You can check that out, and you can send emails to yourself. 10 days in the future, 2 minutes in the future, or 276 days into the future, or whenever this guy said he would say they're gonna do it, I send myself an email to remind me. People think I'm like a machine, but I just have good systems. So the second person that's critical to your team is the property inspector. I've always just done this by referrals. You can go and first of all, you should always get a property inspector to inspect your properties. Never go in without an appraisal and a property inspector, period. I think there was a scam out there that was having people purchase properties cash because probably the properties wouldn't appraise for them for the price that they were selling at. And there probably would have been a lot of issues that the property inspector would have found. Property inspectors are, for the most part, as long as they're licensed, they're all pretty much on the same level. I take it a step further. In my mastermind course, I have a lot of examples of actual real inspection reports, and you have to work with your property inspector to get them to write the right stuff. So it's critical that you build a little relationship with your property inspector so that you're able to take that information to the negotiation table, so you don't leave some money on the table for some last minute repairs. What are some things you key on in the inspection? This is a screenshot of my mastermind course. You guys can learn more about that at simplepassivecashflow.com/journey. But here we dug into I did a coaching call with a student here. We went through an actual inspection report with them and some sample reports. A lot of things I just can't share on the internet out in the free world, and they're sort of private. So that's part of the reason why it's paid. You get to pay to play to get this information. But if you guys are all doing it yourself, what I would do is I would use the analyzer and look at the capital expenditure calculator. Look at all the components that'll probably eat you alive in the future, and use those as talking points with your property manager or your inspector.
And those big five are the HVACs, the roofs, the plumbing, the electrical foundation. Um, when I work with a client, I'll kind of strategize it so that we get the optimal amount of repairs. For example, if a roof is like 10 years old, you're not going to get a new roof, right? So don't ask for one. You come off across as like ridiculous, and you're not going to get anything else because people will realize you're absurd. So what I normally do is like, all right, the roof is 10 years old. We'll call it out. Maybe there's some shingles to replace, but let's use our social capital, get some other, maybe the HVAC is 8 years old. Maybe we can have them replace that instead. So there's a little bit of horse trading at the end. And this is it's probably one of the most critical places where I come in as a consultant and help people as they close their deal. Question I always get is like, do I go after value add or turnkey? Well, in my opinion, and this is my opinion only, is if you're a high paid professional, your time is more valuable than money. And especially if you're new, I would start off with turnkey. Now, turnkey is sort of the gateway because it gets you started, and now you can start to get some cash flow, which gets some confidence, and now your spouse is actually on board in your corner as opposed to against you, and that momentum is key. And then at that point, you need to decide whether you want to take on more risk for more reward. Um, risk applies more reward, and that's what value add is. Reasons I don't do value add is because I don't really trust people. I'm not comfortable sending $20,000-$30,000 at a time for a property I'm not able to see. I recognize a lot of people do it, and they get inspectors to verify the quality of the construction that you're doing, and they do draws, like, they'll hold back part of the money until key milestones are made and by the inspector and signed off. But I don't know. I just think it's like a single point of failure, right? Like, it just takes the contractor to drop the inspector $500, and now your whole operation is ruined, right? And another reason why I don't like value add is because it takes so long. You have to put in large sums of money and cross your fingers and hope that that lending broker, again, a broker who promised you the world, and come to find out you don't get that loan to value that he was saying, or you don't get that appraised value. And now you aren't able to do this BRRRR strategy that everybody said it was amazing, that they only talk about the successes. Um, Higher net worth passive investors value their time more than money. And for those people, it might make more sense just to go buy a bunch of turnkeys and let it grow, than to take on the actual risk and spend the actual time to go after value add. Do the numbers work locally to you? Well, you have to ask yourself the same question. I mean, the numbers don't lie. Rent to value ratios in prime markets won't work for cash flow. Um, but here's what I say. Some people will be like, well, I just want to keep doing my rental property in San Diego. And I'm like, all right, cool, man. You keep doing that. But you do know that you're going to keep doing this for the next 15 to 20 years, and you're really not going to get anywhere. And at a moment's notice, the market may tank, and now you might lose, 20% of the value overnight. I think what it comes down to when I call people out, and I'm trying to work on not being a jerk and doing this, but people just don't want to get out of their comfort zone. But amazing things happen outside your comfort zone. When you get out of your comfort zone, you magically get away from unsophisticated investors pushing prices up around. What do you find is the most effective way to network out of state? Probably the most important thing as a passive investor is to get to know other investors on a relationship level, as opposed to just some kind of surface thing where you guys just message somebody and say, who's your turnkey provider? Who are you working with? Who's your property manager? Where are your properties? Do you like it? Is it good? All right, see you later. Talk to you later. Not, I mean, you never, like, those guys are sort of a dime a dozen. I talk to them not too often. these people are takers. They never really get anywhere. Before I would be kind of nice to them, but now I kind of can pick them out really quickly, and I just kind of stay away from them. Um, so you're trying to not be one of those people. You're trying to do this organically and build relationships with other investors that may or may not need you. But from what I've seen, um, sophisticated investors and passive investors are pretty nice people, and a lot of them are on the fast track to financial independence, and they're in a good place in their life, and a lot of them are willing to help out. Um, it may just need a little bit of a free dinner that you buy them or something like that, or just a little bit of appreciation, or most times it's you helping them out. One of the biggest flaws with networking is, or in doing this, is like you say, well, let me know how I can help you out. Well, no, you go figure out what that person needs and you go out and do it for them, and then hope that that person is a cool guy and will help you out when you need it in the future. Um, be careful of this quid pro quo stuff. So, I mean, if you guys wanted more of these networking tips that I kind of go to simplepassivecashflow.com/people for some tricks and tips there. But just be a genuine good person, be in for the long run. So that's why I have that Facebook group. A lot of people I've talked to on the phone with, and they seem okay, but that's the free group. The paid group is a little bit more potent, actually a lot more potent. Half of them are accredited investors, and a lot of them are a lot more serious. So, but you can do this on your own, right? Another thing that I'll mention is the local real estate group is probably not the place you want to go as a passive investor. They're kind of said that if you want to learn about investing, go to there, but most times that place is just full of people who don't have money and not necessarily what you are looking to do as a passive investor. Um, when I first went to those, I got really icky feeling, and then I didn't want to even invest in real estate, which would have been obviously a big mistake. But I pushed through, and I luckily got linked up with a few people who were really cool, and that was kind of what propelled me forward. And then you start to realize this whole investing thing it's just a game, and at the end of the day, the currency of the rich are relationships. So the people who race through and built their portfolio the fast way realize, yeah, maybe they hit their $5,000-$10,000 cash flow a month, but nobody likes them. You know, they just got there with stepping on necks to get there and just asking. Where people who are, I don't know, me personally, because I meet so many people doing this podcast, I'm able to meet a lot of people and kind of keep them in my life, and it's been one of the best things about doing this whole podcast. So again, build relationships with people who are actually doing this, and be nice to them, and they will help you out. Here's a thing called a Sankey diagram. And for those of you guys who have trouble explaining this to your spouse who really doesn't get what the heck you're doing, it's a good way to visually outline how much money you're making and where it's going out and how this will change over the years. If not, it's just a whole bunch of numbers, but hopefully this one's a little nicer with a bunch of colors. So this is where I was back probably about 10 years ago when I used to work in construction. There I am. This is my budget. I made $5,000. I paid some taxes, paid $2,000 for housing, and then I spent a bunch of had various expenses there. Luckily, I didn't have kids, so I had a lot of beer money there. But as times goes along, this is sort of the progression. I would pick up a rental property, which would just increase my income, and then I could just save even more and more. So my savings goes from 150 to $450. Year two, you buy another property and it goes even higher. And personally, for about year three doing this, like 5 years out of the college, I started to realize that this was my ticket out of the rat race. And I realized I needed to keep doing this, and this is where I got really motivated, and I got more and more and more rentals as time went along. So there was a question here in the Q&A box, and we're kind of getting up to the end. So make sure you guys ask your guys questions before we close this webinar. If you make close to 30% returns passively on leveraged single-family home investments, what do you make in syndications to make them even more attractive? So most times in syndication, you're seeing, I would say, 80 to 100% returns in 5 years. So like 15 to 20% a year. Um, Sometimes you have to wait like the 4 or 5 years to get most of that, but it's definitely less than 30% for sure. But with single family homes, they're just not scalable. With 11 single family homes a few years ago, I was having an eviction or two every year and a big catastrophe that happened every quarter, like a HVAC going out or this plumbing thing or this hurricane came through and bunch of some flooding in the backyard, nothing big, but like a few $1,000s, $1,000 of repairs. So it's not hard, and your property management is doing that on the day to day. But 10 and 11 single family homes, that's only like $3,000 passive cash flow at a few $100s per property. It's nothing to call home for and like say, hey, I quit my job, right? You're gonna need 3 times that, almost $10,000 passive to be able to change your life. So take all those numbers that I said and multiply it by 3. Now you've got an eviction every other month about, and you've got a catastrophe that's happening almost on a routine like 3-week basis or a month, every month. And that's when you see it start to become a job, and a low paying job as it is, even if you have a professional property management doing your dirty work for you. So like I said, rich people, they value their time over money. This is why I stopped going to the grocery store and just buying these pre-made meals at this time a lot of times, because my time is more important than to save a few cents here or there. I mean, I still definitely waste too much time waiting in gas and going to Costco to save like $5 on a tank of gas. But you guys get what I'm trying to say here. And this is why I think single family homes are a great way to get your net worth from zero to that first critical mark, which is $250,000. Maybe you might even be still buying single family homes from $250,000 to $500,000, but from $500,000 and up, you really should start to think about syndications of private placements. It's not going to be overnight, and you may still do both, which is great because now you have 2 places where you can cherry pick the best deals that are coming through. Here's that little quote that I tell for most high-paid W-2 employees: if you're able to save more than 30 grand a year and have substantial liquidity, you're better off going to the syndication stuff. And read that article. I mean, this article I literally change it every few days and add more and more stuff to it. I mean, one day it might even be a book, I guess, if I could write decently. But read that article. There's actually a graph in there that I created to sort of explain this point. But this is all part of this progression, going from simple passive cash flow 0, which is, hey, you got a good job, great, congratulations, enter the workforce, save some money, 25 grand to get a turnkey rental. Now just work and to get your cash flow up and your net worth up to $250,000 and higher. And then at that point, you transition to syndications. And then, that's simple passive cash flow 2.0 and simple passive cash flow 3.0, which is, you start worrying about money and you start trying to find that passion, which may not necessarily be that stupid game of golf, but something cooler, which a lot of people, if you want to play golf, that's fine. But you have the opportunity to do something not because you have to make money, which is pretty neat. So in the mastermind, what I try and do is we alternate we do 1 week of topics of, we're trying to do something more granular, like, we're going to go through this inspection report together or talk about this turnkey rental. And then the other week we'll dissect the syndication, or we'll talk about infinite banking or QRP, something more high level, more wealth, general wealth building. For most of my investors who are making over 100 grand a year and able to save $10,000 to $20,000, the elites, by the way, are able to save $25,000 to $50,000 a year. But for most people, I would say they could be financially free in 4 to 7 years. And with that, begin with the end in mind. And I always tell them take the more passive approach. But whoever said like, there's always one person who's thinking, well, I'm just going to go to passive investments all the way and like syndications, LPs, yeah. But remember, if your net worth is not like $250,000 to $500,000 at least, like you got to do it. You got to get that net worth up, right? Question here, how many turnkey single family homes do you need to transition into syndications? Now, I don't know. Like I said, it depends on your net worth and it depends on your network. Your network is your net worth, as they say. So there's no hard and fast rule, and it's different for everybody. If you're not an accredited investor, you need to be sophisticated. So getting some rental properties under your belt is, there's no hard and fast definition of what a sophisticated investor is, but I'm going to go on a limb and say if you own a few single family home rentals, you're definitely going to be sophisticated in my book. And the thing about syndications is you can be really dumb and invest in syndication, and at that point it's really easy to lose money and invest in bad deals, because you really can't tell from just reading a pitch deck if it's a good deal or not. A lot of times the prettiest PDFs are not the greatest deals, and you really need to have some sort of background in owning your own properties and being an operator. But you definitely don't want to be an operator forever. That's, at that point you start to ask yourself the question, and this is the point where I got to. I realized that I wasn't the greatest at being an operator, and at some point it's better to let the pros do this. Being a mom and pop investor is great to start and learn the concepts, but my job was to be a passive investor and to live a fulfilling life, not of being an asset manager or property manager. Again, if you go in that article, there's this graph like this in there, and then hopefully that also fills you in on like, how much liquidity do you need and how much money you need to save every year, because a part of it is how much velocity do you have and how much of your network is growing. This is not to say that you can invest in the syndication, but this is when you should start to think about it. But it's very difficult. I don't know if I'm repeating the same thing over and over again, but sometimes that last, people say, I'm a robot. Is there anything I'm missing that is not on this graph? This graph is just a guideline. It's not like a hard and fast rule. So, here's the progression. At that point, you start to pick up these syndications, which are a lot more scalable. You keep having the rental properties, and at this point, I call this a crossover point 2.0. You guys with grass would think it's kind of funny, but if the red one was like my motivation at work, I got to be a pretty horrible employee at that point, because I saw like, why would I want to work, I don't know, 80% or 50% harder for 10% more pay? It just doesn't make sense, especially when your expectations are constantly going up, and the money you're making from your investments are just skyrocketing at some point. Not too long ago, LinkedIn would say, hey man, you want a job? I'm like, no, I'm not interested in a job, because these syndications and this whole passive real estate thing was working for me. Again, if you're going back to that earlier chart, there's so many ways you can invest in real estate. Here's one of those famous graphs I made that a lot of people liked, that kind of outlined a lot of different investments, and kind of showed you what are more of the higher risk, higher returns, or higher risk in terms of return. And then this is all a game of like stepping yourself up to the more exotic investments. It's all part of the progression. And turnkey single family homes is sort of on the, this is the starter. This is like this is like the tempura roll, where the California roll is sort of like the private money lending. So here's probably my most popular slide here. This is the old, if I had $500,000 here, how I would invest it. I would start off with these turnkey rentals, get yourself to be sophisticated, start to go into some syndication deals, maybe keep doing both, right? You saw that turnkey rental got picked up there. Then you start to go into different asset classes, like maybe a mobile home park. One of these days, I'm going to start to invest in life settlements. Those are kind of neat. Then you go after more higher risk, higher return investments, like a assisted living syndication or a hotel syndication. Definitely higher risk, higher return. And I think it's crazy. Like most unsophisticated, lower net worth people, they gravitate towards the more higher risk, higher return stuff. But if you notice in this graphic, the pyramid's base is turnkey rentals and class B and C apartments that are hybrid cash flowing and then have a value add at the end. There's a concept that I talk a lot about is my opportunity fund. You guys can learn more about that at simplepassivecashflow.com/O fund, where you use the infinite banking along with investment like AHP. But this is the progression of being a passive investor, and I've met a lot of cool people, and I really appreciate the kind feedback you guys have given me over the years. You guys can read more at simplepassivecashflow.com/testimonials. Why do I do this? I see a lot of people struggling financially, long commutes, a lot of stress, and just thought that Simple Passive Cash Flow was a cool way to give back to others. And thanks for staying to the end. Here's your special prize. If you guys are interested in the tour that we're doing July 21st to 24th, Birmingham, Atlanta, Huntsville, we're going to meet some providers, property managers, single family home apartments. This is your chance to hang out with me and really get a sense of what is a B-class property or C-class neighborhood, for example. If you guys can't come, join the Huido Pipeline Club, simplepassivecashflow.com/club. There'll be some cool stuff coming out here very shortly. So if you guys don't have any more questions, type them into the question and answer box. But nothing comes up. Thank you for joining on, guys. And if you guys are interested in the group coaching mastermind, which just talking to a few people today, maybe that's a bad term, mastermind, because I think people get overwhelmed, but it's more of an incubator, accelerator for new passive investors to get around the right people, to start building relationships with the right people. Check that out, simplepassivecashflow.com/journey. All right, and we'll talk to you guys next time. Bye.
Hey, Simple Passive Cash Flow listeners, I'm very excited to be announcing our very first Hui Investor Tour. I'm taking you guys out to Atlanta, Birmingham, and Huntsville. Check out some properties, meet some people I work with, and for the most part, just get you guys comfortable with the Class B and C locations out there. I think a lot of you guys are going to be pleasantly surprised in what you get for $100,000 out there that can rent for potentially $1,000. So it's be taking place on July 21st to the 24th, 2019. And I think one of the biggest draws is you guys get to connect with some of the other people out there. So check out the info page here. We've got some early bird pricing. The price will likely be going up. One of the big reasons I'm doing this is because, some feedback I've been getting is, I've sent some people up to kind of connect with my folks, and then they come back and they're like, oh, wow, that really makes me feel a lot better. And I was able to build a lot of personal relationships with property managers and get a sense of the neighborhoods up there. And now I don't got to go back because I don't want to go back to Birmingham because it's a little boring. So some of what you'll see is, we'll take some tours of some properties, some of my properties. We'll even check out some apartments, and we'll meet some people. We'll have some dinners together as a group. So that's the big thing about building relationships with other serious and passive investors. The itinerary will be on Sunday. We'll be arriving into Atlanta. You guys are in charge of your own flights because you guys are grown-ups. we'll kind of rally up in the evening. That'll be the travel day. So rally up in the evening at the hotel. I'll have a little program for you guys. We'll kind of do a little mixer. We're trying to incorporate a lot of fun into this. But the next day, Monday, it's our early rise and shine. We'll be heading out to some properties and meeting a bunch of people. And then we'll try and do a little bit of fun tourist activity, maybe either on the Beltline, which is the old converted railroad tracks it's kind of a big linear park, upscale park that goes around the city, or we'll do something in Decatur, which is on the east side of Atlanta, which is where a lot of my rental properties are, and you'll see a lot of the gentrification out there. Also on the next day, on Tuesday, we'll be heading out as a group to Birmingham and kind of be doing the same thing there. Birmingham's not as fun, but we'll have some barbecue out there, and then we'll do another evening workshop at the hotel. Hotel arrangements will be all at we'll try and make it all at the same site. You guys are in charge of your own hotel, but we'll make sure that we'll all kind of stick together. It's a lot safer and it's a lot more fun, and it gives you guys an opportunity to connect with each other. On the fourth day, Wednesday, the plan is you guys are going to go out to, you guys can choose your own adventure. You guys can come with me to check out my deals in Huntsville, check out the location, or if you guys just want to go out and break out, there's a Kansas City and Braves game at 7:30, where you can go see that mythical panda at the zoo. So, that's one of the things why I like investing in real estate. It gives me an excuse to go out to places I wouldn't, and, do some tourist activities and be able to write it off as a business expense since I'm out there doing business most of the day. So it's going to be a very fast-paced, fun trip. The idea is get you guys in there, get you guys acclimated with the location, get you familiar. We've got a lot of special guests, a lot of the people I trust, and they'll be dropping their knowledge on you guys, helping you guys out. It'll be sort of like a boot camp style. You guys can be able to ask me any questions. I'll be with you guys the whole time. And make sure you guys hurry up. And our pricing is going to be going up after the early bird special. It's going to be a little bit of price break if you guys want to bring your spouse. Again, you guys are on your own for your guys' hotel and food costs, and we'll try and figure out a way to split up the transportation once we get a finalized head count at this point. Mastermind members, if you guys haven't heard about that, simplepassivecashflow.com/journey, you guys will be getting a 30% discount. Some of the frequently asked questions here, we talked about the hotel. We'll be trying to get a block of rooms all in the same place, just mostly again for safety reasons. But I want to make the tour very flexible for you guys. So if you guys can only make it on like 1 or 2 days, that's better than nothing. And you guys will, you guys be into the whole program of meeting the folks and seeing the right things. But if you just want to dig out and go to a Braves game, that's totally fine with me. We're going to try and keep the group size a little small, 8 to 15 people, enough to fit in a van and a few cars, just so everybody gets to meet each other. I always try and keep it a more of an intimate environment, kind of conducive to networking. And I personally would fly out of Atlanta the day before or day after. Or if you want to turn it into a vacation and go to Orlando and go to Disney World, that's up to you. But if you guys have any more questions, don't be afraid to email me, lane@simplepassivecashflow.com. Check out the website, simplepassivecashflow.com/tour2019. And I hope to see you there in June 21st in Atlanta.